Hi, Steve Van Metre here, and welcome to your Monday night premiere. We take about 15 minutes every Monday and Wednesday night to try to answer your questions and make sense of markets. Yeah, it doesn't really make any sense today, but I do want to offer some explanation to this huge rally. What the S&P closed up 7%. I imagine that's a percentage record or something close to it. And you have to understand the markets are irrational. If markets were rational and pricing and everything was going on, you would expect them to go down. We have first quarter earnings season coming up pretty soon. And if you think that that's going to look good, or their outlook for the rest of the year is going to look good, then you probably are pretty delusional. So the issue is, why are markets rallying? Because everybody thinks this is the bottom. Everybody thinks this is the bottom. I said that twice because that is what you see and hear people talk about online. The bottom is in, you have to buy. You talk to your friends, this is the bottom, or you get emails, this is the bottom. It is not the bottom. But that's what people think, and that's why people are playing chase. This is no different than going to Vegas and losing a bunch of money and then doubling down your bets, thinking that, okay, I've lost the money, and statistically, if it goes, if I lose this many hands in a row, that I should win the next, and I'm going to double down, and then you go broke. And the simple reason is Vegas was not built on winners, and neither was the stock market. So just because you see a big move in stocks doesn't mean anything rational is happening. For all we know tonight, we'll go the opposite direction. Who knows? Well, let's get to your questions. I understand you run a long-only fund. That is correct. And the timing of when long-term treasury prices will peak may not be important to you. Okay, the second part's not that true, but let me explain for those of you who do not know what a long-only fund is, and that is what most I don't want to say investment advisors because they don't manage money. What most money managers are long-only mean they do not take short positions in the market. So that would be me. I'm a long-only manager. Now, is the peak in treasury prices important to me? Yes, because I have treasuries in every one of my client portfolios. So absolutely, it is important to me. We'll go on. It wasn't important to many of us either prior to the coronavirus. However, now I'm sure you can empathize that many of us who are also bullish treasuries may have lost their jobs. And I do understand that. And I'm very sorry to hear, but I just assume that does apply to some of the viewers here. And I hope things can turn around very quickly for you and that you can get back to work and that everything's going to be okay. I mean, we know things are going to be, we just unfortunately don't know when. And may need to value the timing of yields falling more seriously, as we don't want to miss the move and still need to tap our ETFs for cash needs. Yeah, this is totally understandable. A lot of people don't understand, why does the public sell at the most at the bottom of bear markets? Well, there's two important reasons here. One is, okay, you're twisting my arm. I've had enough of these losses. Ow. Okay, I'll sell. I'm done. I'm out. The second is, for just exactly what this person sent me the question is, I might need the money. And a lot of people don't realize that, is that there are plenty of investors that cash out their IRAs, 401ks, and Roth IRAs at market bottoms because they've been out of work and they have bills to pay and they have mouths to feed. And yeah, I totally get it. In your best case scenario, based on my research, when do you postulate this drop in yields to zero to occur? Now, I'm not 100% we're going to get to zero the first move. We could. I'm not 100%. It could get close. So I do believe that in time, we will get to zero or negative. It's okay. Range would be helpful. I believe within 90 days, I believe we'll see the very first move down in yields. And I wrote about this in my coming Friday update. I always write them a weekend before. So I think there'll be a move down, a move up in yields, and then you'll get the eventual bottom. Guess we go this way in the video. Because yields don't bottom until after the recession is over. Now, recessions are around 2 years, although right now everyone thinks recession ends in 3 months or 3 weeks. It's not the case at all. So I'm feeling 90 days-ish for a exit point, and then maybe a year and a half if you miss that one to the next one. So keep an eye on that. How do I calculate the fundamental value of TLT, or will it say any bond ETF? You don't. What do you think the fundamental value for TLT based on the current interest rates? There is no fundamental value. Bonds trade inversely yield. So it's not like you'll find a bond trading at discount to yields. Now, you might find a bond trading discount to yields that is not a treasury bond, but in terms of treasuries, which TLT is a treasury bond fund, you're not going to be like, oh, hey, yields are here and there's this offsetting, price in the bond market that I need to jump in. That should not happen, or if it does, it will be extremely short-term in nature as the market immediately figures it out and changes it. So why do I ask these questions? Well, for stocks, I can use PE or price to earnings or price to sales or discounted cash flow model. That's absolutely correct. It does not work with U.S. Treasury bonds. So I want to see if there's something I can use for TLT. No. Maybe other bond funds. I'm not aware of that. I have very little interest in corporate bonds at this moment. And many people will when they find out how much corporate debt will eventually default in the midst of the next recession. So I made a note, it's possible to identify an undervalued stock, which is value investing. And I think using PE or PS is great. Bonds always trade at their fundamental value. It's their perceived future value based on the direction of interest rates and consumer prices. That's what really matters to bond investors. So good thinking. Unfortunately, I don't see how there's a way to do that for fundamental analysis on a bond. Maybe on a corporate bond, if you're trying to find out, hey, is this company going to repay this bond, or maybe it's below value and it's going to go up, but not with treasuries. All right, let's go on to the next question. Got another question for you. How do you measure inflation? Okay, how do I measure it? The proper way is you look at the expansion of the money supply. So you look at the M1 or the M2 money stock. Both you can find that both of those, the data can be found on the Federal Reserve database, or FRED, which we look at regularly. The Fed, however, the Federal Reserve looks at the change in consumer prices. I'm going to assume the CPI does not tell us the whole story. No, it tells us kind of the end result. And that's why the CPI is a very lagged indicator, because it doesn't really tell us. It tells us what has happened. It doesn't tell us what's going to happen. For example, if we wanted to look at the price of, say, gold or a stock adjusted for inflation, how do we do that? Also, in general, how much more expensive is the cost of living now compared to other times in history, like 70s, 60s, and 50s? So the Fed looks at personal consumption expenditures, which is a measure of consumer spending. I don't find it very accurate because the Fed uses lag data, and it's not, the technical definition of inflation is the expansion of a fiat currency. It is not the expansion of prices. So rising prices is an offset, is a result of an expanding money supply. It just tells us what has already happened. That's why I don't like it, because it's not accurate. How would I go and look up inflation? You can go to this website, U.S. Inflation Calculator, and it's kind of neat. You could say, if in 1913 I purchased an item for $10, which I imagine was a lot of money back then, today the same item would cost $261. So let's say you went out and bought a $50,000 car in 1913. Today that car would be worth $1.3 million. It's pretty cool. All right, next question. Let's get back to where we're at. Here we are. A bit dated article, but I always wondered if this would be something the Fed would utilize as a tool to prop up the long end. He's referring to the long end of the bond market higher to save bank lending. And the article is, will the Fed cap interest rates again? And I believe they will. And what that means is, so let's say, for example, the Fed came out tomorrow and said, we're going to put a cap on 30-year interest rates at 1%. And all they're going to say is, we will buy any bond that trades over 1%. So effectively it puts the value at, all of a sudden you see bond prices go up and sit, because everybody that sells, the Fed's going to sit there on the other hand and say, here's your money, here's your money, here's your money. They have done that before. It's been done. We've done it. Japan's done it. I expect we will do it again. I read a lot of articles that say the national debt is 21 trillion. It's more than that, 22 or 23 now, and talk about how bad it is. Of course, it's terrible. But how much does the rest of the world owe to us? And that's a pretty good question. It seems to me that you got to look at both numbers. All right, so this is a good thinking, right? It says, all right, I owe you money and you owe me money, and so we should net that out. right? To find out what I really owe you and what you really owe me. But think about this. So let's expand our thinking a little bit. In the world all liquidity system, why would the U.S. government or Federal Reserve buy foreign held debt? It wouldn't. There's no reason to. Now, I've looked in the past. I do know we have foreign currency reserves, not a ton of them, but I've never found any evidence that we, at the governmental level, own foreign bonds. I don't know why we would need to. Now, do investors own them? Yes. There's things, if you look in your 401k, you'll find, like International Bond Fund. Guess what you're buying? You're buying foreign government debt. But I don't think the Fed or the U.S. government owns it. I could be wrong, but I'm pretty sure we don't. I've looked at that once before. That was the answer that I came up with then. Many of us are looking at the futures. So this is the overnight futures market that opens at 3 p.m. on Sunday, 3 p.m. Pacific. For example, the S&P 500, how good or how accurate or how poor? It is very accurate. I look at it too. I look at the equity futures, the commodity futures, and I look at the bond futures. Just kind of see, does it necessarily mean, when you go to sleep at night and it's up that you're going to wake up and it's going to be there? No, could be higher, could be lower. But yeah, it's pretty accurate. I mean, if futures market is showing up, then you can expect the cash market to open higher. All right, great questions. Let's close that out and get into, where am I at here? The NASDAQ McClellan Summation Index. So we're seeing the market bounce because we're seeing this happen in the past where markets are saying, hey, it looks like there's some liquidity coming back. There's going to be a bounce here. But in the past, we've seen, like back here in October of 2018, it bounced and then rolled back over. So we're going to see this go straight up like it did at the beginning of 2019. Probably not, but you never know. It just would seem strange that corporate share buybacks, which have driven this market, that are disappearing rather quickly, are going to, so they're gone. The driver of the market's gone. You're going to see money coming from somewhere. I mean, it is realistic. There are 10 million people that are unemployed now that are not buying stocks. Corporations are massively cutting back their share purchase program, canceling them. So the question is, where is all this money flow coming from? I don't know. That's why I don't buy that this is sustainable. And according to the MACD flows down here, doesn't look like it, but it doesn't mean the market isn't trying to be euphoric. And you got to understand, that is how the market works. It believes the stock prices are going up until they don't. And literally, investors are crazy bullish. I mean, they can't look past and see that the world is shut down still. They can't look out and say, hey, China's back locking parts of his country down. I mean, they can't see the damage that's being done. They just believe this is the bottom because they need it to be the bottom. If I was down 25% because I was, very confident the stocks were going to go up forever, well, I need a big return to get back to zero. And what choice do I have but to believe? Because if I don't believe, I become a seller. Let's go look and see how hedge funds are positioned. And I want to take a little bit of time to kind of do a little lesson here at how I look at these charts. So Saturday morning, I'm up and Hedgeopia posts this chart and I'm like, whoa, big drop in speculative short positions on 10-year treasury yield or bonds, notes, 10-year treasury notes. Yields is the inverse of that. And I'm like, wait a second, that doesn't match up. So let's go and look at the chart. So first thing I'm going to do is I'm going to go look at symbol TNX, which is 10-year treasury yields. And I see that yields fell. And that chart is as good as of Tuesday, which is March 31st. So right here. And so the week before, you have 1, 2, 3, 4, 5 trading days. And yeah, yields went down some, and that makes sense. But when I look at TOT, the long bond, I see all this selling going in here, selling. You see the candlesticks, they went up and sold. I'm like, well, that doesn't make sense. So let's come back. Oh, whoops. I suppose I should show you what we're looking at. Probably would help. All right, let's go back and look at TNX. So here you see 5 trading days, yields went down, validates the speculators backed out of their positions, because when you close a short, you have to take a long. But as I mentioned, looking at TLT, all you see is every time it goes up, you see selling, up, selling, up, selling, up, selling, up. I mean, it's like, well, wait a minute, that something's not adding up right here. So let's go look at the next one. And you see all of a sudden this big increase in the short positions on the 30-year is almost as if, and it's not the case, that everyone that left their shorts on the 10-year went to 30-year. They didn't. It wasn't quite equal. But now 30 years, the long bond is at nearly the second shortest position in history. This is the all-time record short position. And here it is, the second longest, deepest short position. And we're pretty much tied. So it tells you the market really thinks inflation's coming. It really believes it. And if you own long bond, somebody here does, then you're like, oh, this is great news. Like, I don't care if they cut their shorts on 10-year. And hey, you added shorts on the long bond? Great. Let's go look at what that looks like. And so now all of a sudden you can see TLT here. Let's zoom in and take a look at this charting pattern. So it got up to about 1.2%. This is the price level for 1.2. And then it got up there again. It's now being rejected at 1.2. And you see all this movement here is under massive selling pressure. And so today it came down to, I want to say, roughly around 1.25% and found support and rallied off of it. And that's great news, because what this is telling us is that sellers are trying to defend. It's almost like 1.2 is the last line in the sand now. And we can tell it's probably the last line in the sand. Not guaranteed, but you can tell, because look at the short position. It's the second largest in history. And in order for them to go to the largest, it's go down some more. But to unwind this means they're going to have to buy. And if you break that 1.2, you break this. And I think that this selling up in here is easily overcome, and you're off to the races. So I like what I'm seeing here, and it doesn't bother me the stock market was really up today. We'll get to that in a little bit. But I like this price action in bonds, and I like this charting pattern. You see this nice big inverted pattern running right up to support as part of a much larger pattern that we've looked at, which is this cup handle, shoot higher, come back to the last point of support, and now all it has to do is break through here, and you're off to the next bond bull market, which are very, very short, mind you, very, very short. They last a matter of weeks. You can make a lot of money that way. Let's take a look at West Texas Intermediate. You still see the hedge funds are long. There's really no major adjustment as of Tuesday. And just so you understand, all these people are massively underwater. They were buying these long contracts somewhere between 40, but most of them were up here in this $50 per barrel range. So they're losing money, and they still believe that oil is going higher. So what they did is when oil hit down to 20, they added some longs back. They're doubling down their bets. Everybody's betting on inflation and a quick turnaround in the economy. I think they're wrong. Hedge funds went short the market, of course, then you get a big jump in it. So they're on the wrong side of that fence. Let's take a look at gold. It's backing off. I think I'm going to do a special piece on gold on Wednesday. FYI, the markets are closed on Friday, so it will not be a Friday video. So we're seeing people back off their gold longs. It doesn't surprise me. That's the direction I think gold should go. No real change in NASDAQ long positions, and no significant change in Russell 2000 positions. No significant change in the dollar, although we're seeing the dollar start to rally back. And then a big drop in volatility, which is odd because if you're reducing your short position on volatility, it means you expect stock prices to go up, and yet we see the hedge funds are net short. So it doesn't quite add up to me. But anyways, let's go back and take a look at the chart on the S&P 500. Now, I've adjusted two of these lines. So when you do technical analysis, which is trying to identify where buyers and sellers are at, you can never be in love with where you originally draw the lines. So I had to move these up a little bit. And what happened in overnight trading is we got this big gap higher, and then investors were buying, and it broke through this overhead level of resistance at 2360. Now, what's important to look at is you see there's what's called an island gap reversal. So this is a little island. So you have a gap down, and then you see, and then a gap up. And this is an island in between two gaps. Now, this can be a very powerful situation in the charting patterns because it can imply there's a big move higher in stock prices coming. That's why it's called an island gap reversal, because it's reversing, like making a hard U-turn here. But this charting pattern has a very high failure rate, meaning it's more likely the stocks are going to come back and close this gap. Or both. Well, it's going to have to close. If it closes this one, it closes both of them. So just so you know, it has a higher than 50% chance of reversing this, and we still have not seen a retest of the all-time low. So for everyone who's bullish, you have to keep in mind market bottoms in a bear market take 9 months. And it comes with a lot of selling. And right now we're seeing trading volume start to slow down. So not a big indicator of something going on here of retail investors selling. We're hearing retail investors are buying. And as far as TLT goes, you notice how volume here has tapered off. So it's telling us a lot of this, whatever selling has been going on, is the sellers are running out of steam. And that's going to give the bulls an opportunity to push bond prices through that 1.2% threshold on the 30-year. And boom, there you go, off to the races. So I hope this video helps. And we'll be back Wednesday, and hopefully I will be able to show you kind of looking at why I think gold is headed lower, and we'll see if the markets have reversed by then. But yeah, what a big surprise on today's move. Anyways, I appreciate you taking the time to watch. I'm Steve Van Metre. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.